So give it up for Neil Borate, the editor-in-chief of The Fine Print, a financial content platform dedicated to helping people make smarter financial decisions. With a background in law and economics, Neil has been writing about personal finance since 2016, cutting through, I think, a lot of Gen Zs here when we were in school when it was 2016, cutting through the noise to offer clear, actionable insights. He previously worked at Mint as a mutual fund reporter, then deputy editor before becoming editor personal finance in 2024. Neil has also co-authored the book The Big Bull of the Lal Street, chronicling the life of legendary investor Rakesh Jhunjhunwala. Please give it up for Mr. Neil Borate. A huge round of applause.
Okay, hi everyone. Just a quick poll before we get into it. How many of you invest outside India? Just raise your hands. Okay, so as usual, it's about a fifth of the room. And for many of you who are Gen Zs, students, etc., you haven't yet begun investing in India, so outside India becomes a bit of the next step. But I would argue that actually, given the changes in our markets, our technology, our regulation, you might as well start with both simultaneously. I'm just going to put one basic argument towards what I'm saying, which is that all of us in this room would have either taken at least one vacation abroad or consumed one product which is made abroad. The iPhone, any phone that you consume is made outside India, um, or studied abroad, or worked abroad, right? We do all of these things, but for some reason, we don't usually invest abroad, or if we do, it's a very small amount of money, and that is suboptimal. It costs us returns. And all of that is changing. So for a long time, it was not practical, not possible for Indians to do it. Now it is. Look at this. Can we get the table again? To look at this chart, I don't know if you can read what's on it, but it tells you different markets and how they performed in different years. So India is the one in orange, and there is Germany, which is purple, Brazil, which is light blue, Japan, which is dark blue, US. And this is compiled by ET Wealth. And these returns are in Indian rupees, INR. Now, at the very last column is the 10-year return, and they have not considered NASDAQ. So if I were to put NASDAQ in it, then that would be at the very top. But taking out NASDAQ, Germany is actually done better than India. And this is only if you look at a 10-year period. So if you go year by year, there have been many years in which India has been either at the bottom, like the current year, or India has been somewhere in the bottom half. And you would have been better off had you had some money in overseas markets at that point of time. Now, the Indian mutual fund industry has done a very bad job of capturing those markets. We've had some mutual funds which do it, but if you see the returns, they are horrible compared to what those markets have actually given. And that, thankfully, is changing, and I'll come to how. Next, please. So this is another example of how a mutual fund has done a quite terrible job of capturing the returns of that market. This one is an exception. So take a minute to think about the return here. 22.21% CAGR, not exceeded by Nifty, not exceeded by most of our domestic indices. Now, let's look at the current situation. So most mutual funds have hit the RBI limit. They're not able to invest more money abroad. They're not taking money from us to invest abroad. This is an ETF that's listed in India. But what is the problem here? Can anyone identify it for me? Yep. Exactly. So put it in common language, it's a local train problem. Train is full, there's no place to get in, and you have, therefore, a bad experience. So you have the price of the ETF trading much higher than the NAV of the ETF. So anyone who's buying right now is ending up unnecessarily paying a massive premium simply because jageh hi nahi hai, allow hi nahi kar rahe. People don't know this and they just blindly buy it. History of the rupee. So the rupee in 1947, unlike the WhatsApp forward, was not 1 rupee to the dollar. It was 3.32 rupees to the dollar. Can anyone tell me what was the year in which rupee has fallen the most? So we have gone from 3.32 to almost 90 rupees currently, but which is that one year? You can raise your hands, we'll send the mic to you. Yep. Can we pass? 91, okay, that's one answer. Anyone else? So 91 is a very good guess because we had the crisis, forex crisis in 91, but actually it's not the worst year. That credit, so to speak, goes to 1966. Anyone can guess why? Why is 1966 the worst year for the rupee since its history? Yep, I think you've got it. The war, yeah, the Indo-Pak War. And after the war, our crisis was so severe that they devalued. Now I'm using the word devaluation because today the rupee floats. It's a managed float. That time it was fixed to the dollar, and they devalued the dollar by a massive 56% in 1 year. Just imagine all of your savings, in a sense, lost half their value. This is the Times of India from that year. This chart is my go-to chart for why international investing makes sense. So just a bit of history. If you look at 1900, which is the country with the largest share? This is the global stock market, by the way. This is if you imagine the whole thing as one pie. So which country has the biggest share? Anyone? Look at the colors. 1900. Great Britain, right? Great Britain, 24% of the world. And you see, if you follow that color, it's losing its share steadily but relentlessly since 1900. And you end in 2024 when they compile this chart at 3%. The US is the largest red splash on this chart. It begins at 15%. It has its rises and falls. If you see, there's a bit of a fall, a bit of a dip in around 1990. So what happened at that point? Anyone knows? Yep, go ahead. We'll have to pass the mic. Okay.
The 87 market crash.
That could be one reason, but something else happened. So you have to look at what else took market share from the US.
The US invasion of Iraq.
No, look at which other country took market share from the US.
Oh, the Japan.
Japan did. And the reason for that is Japan had a huge stock market bubble, so large that some of you would have heard, huh? Some of you would have heard this statement that the land under the Imperial Palace was worth more than the entire state of California. That was the magnitude of their bubble, and which is why US, even though it did okay, it lost share in relative terms. Now you might ask me, where is India in all this? Answer is India doesn't exist because we are so small. We are 3% of the world, so we don't figure on this map. When we are invested in just the Indian market, we are in a global small cap, and people don't realize the risk of that. This is a bit technical, but essentially, you've been able to invest abroad for many years under the liberalized remittance scheme of the RBI, and those who've diversified have obviously benefited, but there's been the lack of proper advice or even discourse. You Google it, financial media. I've been a journalist for the past 6.5 years. No one talks about this. So how do you do it? You have some options here. Mutual funds are the easiest one. So feeder funds continue to exist. But like I said, RBI limits have come in, so they allow, very few of them are open right now. They allow very small amounts of money to go out. Multi-asset funds, again, they invest some part of their assets abroad, and they are open because any fresh money they get, they put into Indian stocks. So the problem there is just dilution, that your percentage in foreign stocks keeps coming down because fresh money is going into Indian stocks. Then there are direct stocks or ETFs in the US. So there have been fintechs in India for several years now, Vested Finance, Int Money, Interactive Brokers, which allow you to do this. Um, there are now the most interesting thing why our environment is changing, why this is becoming a very interesting space, is because of Gift City. Anyone has heard about Gift City, what it does? Yep, yep. Everyone in finance would have had some idea of it. Gift City is a physical place near Ahmedabad. It is designed in the long term to be India's version of Singapore or Hong Kong. It is designed primarily for global capital to come to India, including NRIs to invest in India in a very smooth manner. But you can't open a highway with only one side open. You have to open the other side as well. And so Gift City now is also a very good way for us, for Indians, to diversify outside India. So Gift City has one retail fund. Anil was here today, so TSP incidentally is the only retail fund in Gift City. And Gift City has AIFs. Um, who can tell me what an AIF is? Somebody who's Gen Z, who qualifies as Gen Z. What's an AIF? Okay, go ahead. Yeah, alternative investment fund. So the minimum ticket size is $1.5 lakh, above most of what we can invest in, but they are there for the super rich as well. I won't get into too much detail about this. It's essentially, if you use a mutual fund, how do you do it? There are specific funds which have done so for a long time. This is a list of funds which are still open for subscription, although many of them have very small limits. So Edelweiss only allows 5,000 rupees SIP into their overseas feeder funds. List of hybrid funds. So these don't close, but like I said before, the percentage keeps dropping because fresh flows go into domestic stocks. Um, as I said, you can also open a broking account in the US, and you're allowed to invest up to $2.5 lakh each year. Above 10 lakh rupees, there is TCS of 20%, but that's just a tax collection. It's not a fresh tax. You can adjust it against your advance tax. So don't see it as a big issue. We've done a comparison about what different brokers charge. So if you want to go into this, contact me and I'll give you a copy of the presentation. Some people have ESOPs or RSUs abroad. So even if you're working in India, but your company is a multinational company, often you get issued ESOPs in that country, in the US, and people don't know what to do with it. This is a list of AIFs, funds, and PMSs which invest abroad. Some of the big names are already there. Parag Parikh, Marcellus, Aditya Birla, DSP, etc. Just a quick compilation about what are the things to keep in mind when you invest abroad. And this is a bit about the DSP fund. So why Gift City? I'll quickly sum it up. There's something called the US estate tax. So if you directly invest in the US and you pass away, and your assets in the US are above $60,000, then your family has to pay estate tax in the US. So that will not happen if your investments are in Gift City funds. Then Schedule FA applies if you have investments overseas. It's a very complicated and stringent part of the income tax return. So that goes away if you invest through a Gift City fund. And of course, you have known players who are under an Indian regulator, so you don't have to worry so much about मेरा पैसा कहाँ जा रहा है, किसके पास जा रहा है. It's going through an Indian regulator, an Indian entity. Yep, that's it. Any questions? Happy to take them. Go ahead. Yeah, yeah.
essentially, as a user, don't need to do anything, right? Why would you invest in a Gift City fund or so on and so forth? You can directly invest in stocks. Even the exchanges are coming up with, they had come up with something where they will list the top 50 to 100 stocks.
Yeah.
So why do you see that evolving?
So currently, these stocks called UDRs, do you remember the full form? Uh, so these are basically synthetic instruments which are built on existing stocks in the US, right? The liquidity right now is nothing. Like the trading is not happening. Hopefully, if Zerodha and other brokers get into it in a big way, then trading of that will take off. So you can directly buy an Apple or a Alphabet in Gift City rather than in the US. Uh, but yeah, I mean that's equally good. For people who want professional management, I think a fund is still better. You don't have to pick stocks. Yeah, go ahead. Unsponsored depository receipts.
Yeah, it's unsponsored DRs. So basically, I'm from Phillip Capital. We have outbound PMS. We are the first ones to launch that. And that essentially takes care of some of the points that you mentioned. One is that if I don't know which stock to buy, essentially it's a managed portfolio. So that takes care of. And the fact that the requirement is lesser. It's $75,000 against $150,000 for AIF. Comparatively, it's $75,000 for a PMS. So in that sense, I think it's a good start point. Of course, if anybody wants to do a direct trade into the global markets, free to do so. There are multiple brokers. We are one of them. But what we have also realized is that most people do not do enough work from the Indian markets context, even less so from the US markets. Other than FANG, if you move out of them, there's not much that is known per se that way. But having said that, I think it's a very good start point, and we look forward to adding more markets also. And like you said, the US markets, which are the most liquid, in fact, to the extent that the portfolios that we have, which are ETFs, even if you want to do Taiwan, we do a Taiwan ETF, which is listed in the US, rather than go to Taiwan, which essentially cuts the noise and the exchange risk per se. So I think yes. So more strength to the Gift City and the products out
Absolutely. No, and I hope that you guys and others also launch funds, because when you have PMS, etc., then Schedule FA still is in the picture.
there. Correct.
With funds, there's no.
That's true. So that's the next step essentially, right?
Look forward to it. Right. Anyone else? Okay. I'm told that we're out of time. So you can contact me after and I'll give you a copy of the presentation. Thank you.